thanks to QED for having us here. Thanks for EVF for hosting us. First of all, perhaps, for those who are not familiar with Finance Watch, the brief of Finance Watch is to take the perspective of EU citizens as customers, savers, borrowers, investors, and last but not least, taxpayers. Now, this legislative proposal, the banking package, incorporates a lot of new international standards into European law, including some significant milestones, which we welcome. We would caution, however, against some of the proposed deviations from internationally agreed standards. We believe that deviating from Basel standards generally only reduces their usefulness, casts more doubt on the actual condition and resilience of the financial sector in Europe, and in fact weakens the EU's hand in current and forthcoming multilateral negotiations. We would also caution strongly against any proposed rollbacks of the gains in tightening the prudential regime since the last crisis. Now, the current package seems to be based on a number of assumptions, such as regulatory reforms to strengthen the financial systems are now largely completed. We've heard that argument just now. Capital ratios have been restored to more than satisfactory levels. Excessive regulation now is holding back European banks' capacity to lend to the real economy, slowing down the recovery. Now, we would argue European banks, sort of particularly larger institutions, continue to be less well capitalized than most of their overseas peers. Improvements in capital ratios actually are as much due to deleveraging than to improving the capital base. Profitability is still weak for a variety of reasons, but also partly because cost-income ratios are still quite high. And we have essentially seen the European banking sector still sitting on about $1 trillion worth of non-performing loans. Now, only a fortnight ago, a major OSII, that, by the way, had passed all the stress tests previously, had to be resolved. Now, in fact, on the second point, current data from the ECB reports, surveys, do not actually point to a shortage of bank credit holding back economic growth. In fact, the availability of bank credit ranks as the lowest priority concern of European corporates at the moment. To the contrary, in fact, we note that household debt levels in several member states are again at very elevated levels, and both the ESRB and the OECD have pointed out recently that in several EU member states there could be a risk of a correction because of overheating real estate markets. Now, we support the Commission's agenda for jobs and growth, but we think that sustainable growth and financial stability are by no means opposites. Now, there are some unsolved problems which still cause us to question the package. First and foremost of those is the fact that, in our view, the too-big-to-fail conundrum has, despite the recent precedent, still not been resolved. We believe to actually resolve the too-big-to-fail problem, a number of additional measures must be taken. And first and foremost, and that sort of goes back to the previous panel, the BRRD must be applied uniformly across the EU, and there cannot be a pick-and-choose basis. We have seen in Spain recently that the new framework can work. But elsewhere, taxpayers are still being called upon to bail out failing banks to the tune of 20 billion euros. Also, the statutory review of the precautionary recapitalization, which in fact was due at the end of 2015, and today is the 20th of June, 2017, by the way, seems to be overdue and should also be implemented as part of this package. And we believe that the precautionary recapitalization is very dispensable. Secondly, we believe that European banks that are systemically important, and that includes GSIBs and OSIIs, needs to be resolvable, which means that TLAC needs to be implemented. It also means that binding minimum requirements of TLAC, or call it Pillar 1 MREL, should be introduced for OSIIs in analogy to the TLAC requirement. And I'm echoing the point that was made on the first panel by Dominique Labourie from the SRB. In fact, there is a cliff effect between GSIBs and OSIs that needs to be addressed. And finally, structural impediments to resolvability, something that has cropped up in oblique references in the first panel, also need to be addressed. So we need to ensure that the European banking sector becomes healthy and profitable again without losing diversity and competitiveness. And we are very much aligned with that agenda. That means weak banks must be allowed to exit the market. And market discipline must be restored, finally, to the banking sector as well. There is no reason, from our point of view, why taxpayers should be picking up the tab for large-scale NPLs that have arisen at banks. And there's very little justification to dispose of these NPLs into the portfolios of future pensioners. In Europe, as everywhere else, banks need to focus once again on competing on the strength of their assets, offering better products, better service, and also making better lending decisions, not on optimizing capital. Again, we believe financial stability and strong credit markets are not mutually exclusive. To the contrary, well-capitalized banks will, in the long run, fund themselves on more favorable terms than weak ones. And well-capitalized banks are more likely to lend to the real economy. I would like to add, if time allows, a couple more observations on specific issues. First and foremost, Pillar 2 and Pillar 2 guidance. We believe there needs to be a more informed discussion on the proposed review of the Pillar 2 regime, including, in particular, the Pillar 2 guidance. We understand and we share the desire to harmonize supervisory practice across member states, to safeguard financial stability and to maintain a level playing field. But so far, all that has taken place is a technical discussion between regulators, in that case the EBA and the ECB. But facts have already been created. And we believe if the legislator is expected to do anything more than rubber stamp this fait accompli, it must also be provided with the necessary factual basis. We believe that there should be an in-depth review of the recently adopted regulatory practice, which in fact puts about 1/4 of current CET1 requirements into question. And we would also suggest a review of potential alternative approaches before the proposed quite sweeping changes are being put into law. In fact, it is worth pointing out that the ESRB, as well as national supervisors, have already been vocal in questioning the proposed sequence and approach regarding the soft Pillar 2. We also consider it problematic to introduce fairly momentous high-level changes to the prudential regime without having completed the pending review of the macroprudential framework, particularly after the ESRB's comments, quite critical comments, in April. We believe harmonization of the macro and microprudential framework should go hand in hand to avoid discontinuities and regulatory blind spots. We would therefore very strongly urge the legislator to postpone the proposed amendments to Section 4 of Title 7 of the CRD4 until a comprehensive proposal for the harmonization of both micro and macroprudential tools has been developed and discussed. On the leverage ratio, we clearly welcome the introduction of a binding leverage ratio. It has been identified as a significantly more reliable indicator of distance to default, and a more neutral regulatory benchmark. Regarding the calibration of the leverage ratio, however, it's important to bear in mind that the leverage ratio of 3% corresponds barely to the minimum risk-weighted Tier 1 capital under Basel III. And the Commission does not currently propose a leverage ratio surcharge for systemically important banks, GSIBs and OSIs. Other jurisdictions, such as the US and Switzerland, have in fact gone quite a lot further already, introducing requirements of 5 to 6%. We believe a 5% leverage ratio requirements for European GSIBs would purely level the playing field with Swiss and US peers.
Just 1 more minute again.
Wrapping up. Now, we believe that on the resolution side of things, we would like to reiterate that when it comes to implementing resolution, again, picking up on the earlier point, Pillar 1 MREL for OSIs is a critical issue. Generally, we would caution against jeopardizing already fragile international cooperation banking regulation for the sake of short-term gains for the European industry, which, by the way, are ultimately going to prove counterproductive in the longer run. We would strongly suggest to review unnecessary deviations from the Basel framework. We believe that the European banking sector is not yet in a condition that would permit significant concessions in terms of capital adequacy. So we would strongly advise to reconsider the proposed introduction of guidance in terms of Pillar 2 guidance and MREL guidance as a way of effectively reducing capital and loss-absorbing capacity requirements. Financial stability and growth, as I said before, from our point of view, are not a contradiction. If in doubt, however, we would choose stability.